So we've talked about what immediate annuities are. So what are the different types of immediate annuities? Because the type you would want would depend on the type of guarantee you want. You see, annuities, immediate or deferred, are all about guarantees. That's what life insurance companies do. The first decision you need to make, do you want a guaranteed income on one life called a single life, or for two lives called a joint life annuity? When an income is based on two lives instead of one, there's a greater likelihood that more payments would be made over either lifetime, which would lower the monthly or lower the annual payment. You would want to talk to a retirement planning specialist about which type might be best for you, or just send me a question below. The simplest type of annuity is called a period certain annuity. These can have a term as low as 5 years or for as long as 30 years or more. The buyer gives a lump sum to the insurance company, and in return they'll receive an annual or monthly payment for a term they chose. The payments are fully guaranteed to the payee, usually the owner, for the term selected. Now, if the annuitant dies during the term, any remaining payments continue to be paid to the owner or the owner's beneficiary until all remaining payments have been made. Payments end at the end of the term and the contract's completed. It's really that simple. A variation of a period certain is called a temporary life annuity. A temporary life annuity also makes a guaranteed number of payments for a specific term. However, if the payee dies before the end of the term, payments stop. Because now there's a mortality factor involved, the premium required to make that payment would be slightly less than a period certain for the same term. Now, when would you use that? It's not used often, but one example would be a judge ordering one person in a divorce settlement to pay a spouse, say, $10,000 a year until that spouse turns 65. However, if the spouse dies before age 65, the payments can end. A temporary life annuity would fill the obligation to pay the spouse until age 65, but only if the spouse is living, at a lower cost than what a period certain would cost. In this case, the spouse is the payee and the annuitant. Now let's talk about the next type of immediate annuity. Payments that are based on a single life or joint lives. Single life or joint lives. An immediate annuity based on a life contingency is probably most often used to generate income in retirement, since you need payments to last as long as you or your spouse is alive. For simplicity, let's start with single life annuities and we'll circle back to joint life annuities. The easiest life annuity to understand is a single life only immediate annuity. That would pay the highest income per premium dollar. In exchange for a lump sum premium payment, a life insurance company will guarantee a set payment for as long as the annuitant's alive. When the annuitant dies, payments stop. If there's a joint annuitant, the payment would continue until the second death and then stop. Now, sometimes the payment made after that first death is reduced under the theory that one person needs less to live on than two people. Reducing the payment on the first death by a third or by a half would reduce the premium required to make that higher payment when both are alive. A retirement planning specialist can help you with that, or again, like before, just send me a note below. Now, many couples are okay with the idea of a life-only joint annuity policy because they want maximum income while either spouse is alive. Now, I don't see as many single life-only annuities being requested because many people want to make sure they have some sort of guarantee that at least they get the money back that they gave to the insurance company, either in payments to them or to a loved one. And that's where a life annuity with a minimum payout guarantee comes in. In this case, a policy will promise to pay a specific premium on the monthly or an annual basis for as long as the annuitant's living, but also guarantee a certain amount of payments if that annuitant dies early. The three types of annuities are a life with a period certain, a life with a cash refund, and a life with installment refund. And here's how they work. A life with a period certain will make payments for as long as the annuitant lives. However, if the annuitant does not live a specified number of years, say 10 years or 20 years, the payments would continue to the owner or the beneficiary until those 20 years or 10 years of payments have been made. So why wouldn't everybody choose a life with a 20-year certain? Probably a good time to cover how guarantees will reduce the size of the lifetime income stream. You see, the higher the guarantee, the lower the payment. Why? Well, let's look at the way an actuary at a life insurance company looks at it. Let's say you have a male who's age 67 and he's ready to retire now and start collecting Social Security. The life expectancy for a male age 67 today is 16 and a half years, meaning that half of men age 67 will die before 83 and a half, and half of men age 67 today will live beyond 83 and a half. So this 67-year-old decides to take $100,000 for his 401k, and he calls me up and asks me what the payments would be starting in 30 days. And here's the analysis that I would have done for him. Now, these payments are from one of the highest rated and well-known life insurance companies in the country. And these rates are effective as of September 1st, 2022. This company actually operates nationwide, and they say they're on your side. So here's what I found. As you can see from the chart behind me, a life-only annuity would pay $631 a month or $75.79 a year. An annuity that would pay for his lifetime but also guaranteed 10 years would be $630 a month. And the same annuity with a 20-year guarantee period would be $568 a month. So you see, the longer the guarantee, the lower the payment. Here's another way to look at it. Take this rubber band. Now, when there's no stress on this band is going to be as wide as it's going to be. Now look what happens when I start to stretch it. The band gets thinner, right? It's the same with your annuity payment. The longer the guarantee, the smaller the payment. So you can see that a 20-year guarantee would cost this client $45 a month, or about $544 a year. Is it worth it to lose $45 a month to have that 20-year guarantee? That's when you might need a retirement planning specialist, a guide, to help you decide. Now, these examples have been just for a single life annuity, but they're similar for a joint life annuity with a period certain guarantee. Remember, the longer the guarantee, the shorter the payment. So just ask the question below if you have any questions about how joint annuities with a guarantee periods work. Now, I mentioned two other types of annuity payments that have a lifetime guarantee, and that's a life with a cash refund and a life with installment refund. Let's cover them now. A life with installment refund says that if the annuitant dies before the original premium is paid, they'll continue to receive payments. So in this case, it's $100,000. The client's receiving $586 a month. And if he died before he received all $100,000 back, he would continue to receive that. Now, the last option I'll cover is a life with a cash refund. A life with a cash refund says that it would make this annual or monthly payment, in this case $601, for as long as the annuitant lives. However, if the annuitant dies before all $100,000 has been paid in income, the difference would be paid to a beneficiary in a lump sum. The monthly payment for this life is about $601 a month.